this week, historically, going back to 1950, has outperformed 72% of the time, so that's great news. But as you were talking about fund flows earlier and giving a shout out to ETFs, equity funds have been losing money, but ETFs continue to bring on new money. And just 3 months ago, the areas that got hit the worst, growth stocks, small, mid-cap, technology, biotech, they're actually leading the charge, not only in volume, but in appreciation today. So if we see earnings continue to beat the way we did in the last quarter, 2 out of every 3 S&P stocks beat expectations, if we continue to see that, I think we're going to continue to go higher.
This is probably one of the cheapest stocks that we have in our universe, trading at 7 times next year's earnings. And I think the market has overly discounted the financial impacts from the recalls and do not fully appreciate the new car lineup that GM has been rolling out both last year and this year. And so I think this stock has a ways to go to the upside.
But over the past month, it's done really well against the S&P. I think around 6 percentage points. Really, there's a very attractive long-term story to GM that continues to get ignored. Where stock's just right about where it was before the recall really blew up on March 10th, March 11th. But there's a lot of potential for margin expansion here as they get more economies to scale from.
We've done meetings with hundreds of companies post that consumption tax hike, and the overwhelming picture is that things are going much better than expected. And that's not just true of retailers, that's true in machinery, in auto parts, across the board. The slowdown post that tax hike has been much, much less than companies expected, which bodes very well for company earnings for the whole year.